Okay, brilliant. Hi, guys, and welcome to another Understanding Money conference. Obviously, it's a slightly different format to the ones we've done in the past. I think everyone's getting getting used to this new normal, sitting behind a computer screen and seeing family through a flat screen. I don't know about you, but I'm looking forward to kind of things returning back to normal. I've got a haircut booked in I think it's 10 days. It's the quickest I could get my haircut at the local barber booked in. So it's just a testament to the crazy times we're living in. So basically, in terms of Odyssey Wealth, we're a financial advising firm. We help clients mitigate the options and choices that everyone faces in terms of long-term planning. In terms of kind of what the last 12 months has kind of brought us, you couldn't make this stuff up, honestly. I've seen B-grade movies that don't even come close to kind of espousing some of the things that have happened. We're all still suffering with the kind of corona and COVID outbreak. Things are looking good in the UK. Europe's slightly behind. America's kind of looking like it's going to kind of get on top of things as well. You've got countries like Australia and New Zealand who kind of completely locked down, who haven't really got any sizable vaccinations. So, we don't know where we stand, but I think as a general kind of outline, we are heading to a more open world. Depending on which side of the political fence you sit, you probably are happy to see the man in orange, top right, leave the White House. I think quite a few people who work for him were glad to see him go. But certain things, obviously, in the last 12 months have kind of made us pause and look at events and maybe take stock. And one of the things I generally say to clients is, the first step is the hardest. I speak at these conferences. I think we've been doing them for 4 years now. By the very step of you guys coming to these conferences, you have a yearning or a lust to take a next step, and kind of either on a financial basis get a better understanding, get a better footing in terms of where you are, maybe learn from mistakes you've made in the past and navigate a suitable path forward. So taking this first step is always the hardest point. I think we have a gene in us, a procrastination gene. Some people suffer from it more than others. It typically kicks in for me on the weekends, and anything to do with DIY that gets put on the to-do list that never seems to get done. But in terms of finances, it's really important to kind of get a good hold on things and make sure you guys have your own roadmap in terms of planned out and some goals set and aspirations about where you want to get to. Effectively, I don't know if you guys remember the advert from the 90s. I think it was a Nissan advert. Life's a journey, so enjoy the ride. And it's all about, Tendai's theme of this conference is about upgrading yourselves and benefiting and enhancing yourselves. One of the key things is working out which direction are you headed in. What do you guys want to achieve individually, as a family? If you're self-employed and building up a business, all of these things need a direction, need a goal at the end of the day. In terms of destination or an endpoint, is it a early retirement? Is it making as much money as you can in this country and moving back home? Is it being able to afford to put your kids through private school? Everyone is different, but it's important to kind of write these things down and get that sense of where you are currently, where's your destination, and how far away are you from it. I think in terms of the conference and the previous speakers, Fungai and Dawn and Sam and Brian, life has a nasty habit of throwing unexpected things at you. One of the first pieces of advice our accountant gave us is you're only around the corner from your next kind of kick in the proverbials, and life does tend to throw these things at us. If we were looking 12 months ago, no one would have thought, people could be sitting at home being paid by the government for 12 months. No other business owners, never in their wildest dreams thought, they want to trade, but effectively governments put a rubber stamp on them saying, no, you're not allowed to trade, you're not allowed to do business, you're not allowed to do what you kind of get up in the morning, or you have been doing for the last 20 years to do and build up. And the other things, what can you do personally to help you along that journey? And some of the speakers have mentioned things like, basic things like making a will. In the worst case scenario, at least your family gets what you want them to get. Having the relevant protection in place if something worst case scenario happens in terms of a partner passing away. Does that destroy your financial path because suddenly you've got a mortgage that you can't afford? So it's all about kind of taking these steps and taking responsibility for yourself, and making sure that you've got a plan and best implement it moving forward. I always kind of bring this up with clients and say, what is the cost of doing nothing? What is the cost of not joining your pension scheme at work, or just kind of not taking a bit of pain and allocating some of your money to savings every month? We are incredibly fortunate in the UK, and I know there's people in South Africa and Zimbabwe, and I think there was one lady from Canada. So it definitely depends on where you live. But in the UK, we're very fortunate to have a state pension scheme that if you kind of contribute in for a maximum of 35 years, you'll get a full allocation. Currently, that's £179 a week, which is about 9,300 a year. And if you're a married couple, that's a great amount, 18,500. So that can give you a relatively good base, standard of living. If you're an individual, it might be tight, particularly if you've got if you're going to be renting in retirement, or, you had aspirations of world cruises and that, you're just not going to be able to get by on that limited amount of income. And there are pensioners out there who just purely survive on that. But, if you ask them, what would you do? The general answer is we would have kind of made provision earlier on to put more aside when we were working. Effectively, your state pension will cover your household bills and food on the table. And, if you're incredibly fortunate and very good with money, you might be able to eke out a very, very cheap holiday to Europe on a, £35 Ryanair flight. So, that as a base, it's not a bad thing, but it's about what steps you can take as an individual to enhance that and put yourselves in a better position. Is there hope? Absolutely. And part of that hope is taking that first step. You joining the conference today, looking at what options there are. Funga's gone through the different asset classes and types of investments you can go. Sophie and Sam talked about, the property market and what steps you can take to kind of get on the buy-to-let ladder. And all of these things, I consider are great options. It's about having multiple plans in place, and the more plans you have in place, the more chance you have of succeeding at the end of the day. Tying back to kind of the procrastination and starting, the earliest and the best time to start investing is today. You can't do anything about yesterday, but what you can do is start today and look at building up assets. And even if it's £100 a month or £200 a month, if you're paying it into a pension or an ISA or something like that, it's just going to get you that time in the market, which historically has always shown that that's where the growth comes from. It's not kind of trying to time the market, it's paying into the market. Albert Einstein famously said compound interest is the eighth wonder of the world. And when you run numbers, if you go online and look at these online calculators, it's amazing what compound interest actually does for you in the long term. Building up that asset base as opposed to leaving money in a savings account earning currently 1%. Funga, I think mentioned 1% on fixed interest. You're kind of lucky if you're getting 1%. Banks at the moment are offering you 1% on the first £2,000 in your account, and anything above that you're kind of getting a zero in front of that. So just as a kind of comparison between savings and what you could look at to achieve with a pension, and the difference time in the market and investment growth does make. Firstly, pensions in the UK attract tax relief. So you're getting an enhancement of kind of 20% upfront or 25% net return instantaneously compared to savings. But when you look at the overall impact of a higher growth rate over time, your pot at the end of the day is going to be sizable in relative terms to what money would have been sitting in a mattress under your bed or in a bank account. So, as I said, in the UK, and this might not be applicable in Canada or South Africa or Zimbabwe, but pensions are a great way. One of the examples I always say to clients is the easiest, or I ask the question, what's the easiest way to get to £1 million pension pot by age 67? And Funnily enough, it's a pretty simple solution. It's start paying into a pension on the day you're born, at £25 a month. And if you're getting, 8.5% return, which historically is roughly where the kind of FTSE index or an S&P index sits, you're likely to have a pot in excess of £1 million. Do we all do that? Absolutely not. Have I started pensions for my kids? Absolutely not. Should I? Yeah, I should, and I just need to kind of pull that trigger and do it myself. So it ties back to kind of, we all kind of in our deep seated hearts know what needs to be done. It's just taking that action and taking that pain and taking the initial steps. In terms of the options, in the UK, we've got things like pensions, ISAs, investment accounts. There's tax incentives on certain investments. If you go into very small companies that Fungi mentioned, there's schemes like EISs and enterprise investment schemes and seed enterprise investment schemes that offer kind of a huge tax rebate because they are such high risk. But generally, historically in the mainstream markets, you are going to experience a bit of a roller coaster ride. And this is kind of tantamount. If you look at the gray area in the background, that's the S&P 500 in the last kind of 40, 50 years. You can point to any 3-4 year period and, you're going to have a wobble, whether it is a major wobble in terms of the 87 crash, the dot-com crash, the financial crash in 2008. Or most recently, almost exactly 12 months ago, we had the kind of Corona crash. The FTSE 100 in the UK dropped about 30 odd percent. And we broke into positive territory again about 3-4 weeks ago. So, what losses you kind of experienced in 2020 have almost fully recovered. And that's the nature of investing. It's about being in the market, riding these ups and downs and benefiting from the long-term growth. I think Tendai, just before the introduced me, mentioned, that people definitely get the sense of sitting on the sidelines or get this kind of sense of we've missed out on that opportunity. And it's very easy to kind of see something. And the most recent one was GameStop, which is an actual computer game store in America that you could go in and buy a PlayStation game on a CD or whatever else they sell them on. Didn't make a lot of money. Almost everyone kind of realized that they're kind of dead in the water. Is there someone going to be walking into a physical store in 5 years and still buying a computer game? But effectively, there was a quirk in the way people were shorting the stock. They were borrowing the stock, knowing that the share price should actually plummet and they would hopefully sell this. And they called it a short squeeze. So there were more kind of people short borrowing the stock than there was stock available. So when we call them good delivery needed to be kind of the stock needed to be paid back, there wasn't stock. So we saw a share price go from kind of $4 to upwards of nearly $350 in a matter of weeks. And, you just got to realize, one of the tantamount ideas that you kind of got to keep in your mind about these things is there's no such thing as a free lunch. Kudos to the people who jumped on that bandwagon early and managed to ride that trade. But you'd probably find 70 to 80% of people got in too late. They were buying at kind of the $300 mark or $250 mark. And what happened next, it was kind of predictable. What happens with all these kind of things, it plummeted back down. And, if you didn't sell out, you kind of were potentially a paper millionaire for a few hours and then lost it all. So in terms of the practical kind of steps you can take, it's about just putting the basic and simple measures in place, taking advantage of what's available in terms of the mainstream, making use of your pension allowances, making use of your ISA allowances, investing in, yes, you could build your own portfolios and spend hours researching that. But I'll bring this up as an example. This is asset classes in the S&P 500, which is the main American index in terms of performance, top performing and bottom performing, and in that rank. And if you just look at the purple stuff, light pink, utilities, some years sitting at the top, 2011 top performer, 2012 the absolute worst performer, 2014 best performer, 2015. So unless you're kind of glued to these markets and you have a real insight into being able to kind of foresee where this performance is going to transpire, we always say it's about mitigating risks and having a very, very diversified portfolio. And one of the best examples or best ways to achieve that is making use of things like mutual funds or unit trusts in the UK. You really are delegating that expertise to that job to an expert. Fund managers who have a team of researchers behind them, team of analysts in the background doing the numbers, crunching the numbers, looking for opportunities. It's just not something most people have time to do, or the inclination or the expertise to do. So, it's about starting, building up these asset bases, and overall, it's about reducing the risks. Not everyone is able to pick that winner. If everyone could pick that next winner, the next kind of Facebook, the next WhatsApp, the next Twitter, or the GameStop in that particular period, we would all be millionaires. We would all be living in a utopia. And unfortunately, life doesn't work like that. It's about mitigating the risks, putting robust plans in place, plans that have been proven to work, the last 40, 50 years. Paying in money regularly into your pension is just going to stand you in far better stead, as opposed to kind of relying on a lottery win. And it doesn't matter how much you scratch those scratch cards, the likelihood is the odds are against you. You're not going to achieve those goals if you're relying on that. And that's what we kind of basically do with clients, is take them on that journey, give them the expertise, give them the tools necessary to kind of put in place a roadmap for them. Dealing with business owners, looking at, what is your exit strategy? When is that? Is that 5 years, 10 years, 15 years? What do we need to kind of objectively look at? What milestones do we need to put in place to be able to achieve your kind of retirement at X number of years or at X number of ages, and what things we need to kind of cover off now early on, and what we need to cover off maybe later on. One of the examples kind of Brian Doctor gave from Vitality was, what risks do you have as a young family? And, the biggest impact you have as a young family is if something happens to either of you, whether you start paying in £100 or £500 into your pension this year or next year, it's not going to have that much of a material impact over the next 40 years. But if something happens to you now, if you've got kids, that's going to be an absolute catastrophe in terms of your finances, and that will have a lifelong impact. So we work with clients in looking at the overall picture, the holistic picture, to say, look, we've got a budget. We need to allocate some of this to the pension, some of this to the ISA. But we also kind of need to tick some of the boxes in terms of, worst case scenario. You've got your car insured. Some people have their dogs and their rabbits insured. Why don't you have your income insured? So we kind of look at ticking those boxes, or at least kind of putting those ideas on the horizon to say, look, you may not be able to afford it now, but this is something you really need to work towards. If you're a business owner, that's an incentive to kind of go out and get that next deal. So this is an example of what we do with clients, be able to build kind of financial models for them, outline, in a quantitative or an imperial manner in terms of their assets, what their kind of financial future looks like. This is a kind of a cash flow model that we build for clients to say, between now and 65, your job is to go out and earn money and pay the bills. If you've told us you want a retirement income of, say, £3,000 net a month, there's likely to be a shortfall. What steps can we take in the next kind of 10 to 20 years to kind of mitigate that shortfall or minimize it? Do we need to use brute force and pay in more money into the pension, or are you comfortable taking slightly more risk? Can you afford to take more risk if it doesn't work out? Are you going to have a much bigger shortfall? So these are the things we're able to kind of demonstrate to clients, and put meat on the bones to say, look, this is your kind of roadmap laid out for you. We see a couple road or bumps in the road. This is what we kind of need to do. If you could earn an extra shift, work an extra shift and pay X amount more into your pension, that's your shortfall gone. The key thing I work with clients, the metric is the investment returns. If we're looking at, a 20% investment returns needed to cover the shortfall, that's kind of unrealistic. If we can get that down to kind of 3-4%, bang, that's half the job done. So in essence, tying back to the kind of theme of the conference, upgrading yourselves, what steps can you take? It's about looking at, starting is the first point of call. Making sure that you've got your own financial house in order. Are you kind of spending less than you're getting in? That's the key thing. Are you running in the black as opposed to running in the red every month? And if you are running in the red, what steps can you take to kind of turn that around? What debts can you pay off first that are costing you the most, and getting yourself onto that kind of second step. You've taken the first step of educating yourselves and looking at the options. The next step is about fixing your house, getting yourselves into a position where you can kind of make a positive change in terms of moving forward in your finances. In terms of financial advice, obviously we are all regulated by the FCA. Both as a company, we're regulated, and myself as an individual. So our job is kind of work with clients to make sure we're doing the absolute right thing, because it can come back to us in terms of complaints and redress. So, that's the difference between kind of doing it yourself and getting professional advice is, we do this day in, day out. I work with accountants, I work with lawyers. If a client comes to us with a position and we need to kind of say, well, we know for a fact this is the wrong route to go down, you could be, let's just change that up a bit. We're able to add value in that regard. In terms of investments, all investments go up and all investments go down at some point. If the price didn't change, you couldn't make money on them. So it's just about looking at the options, working out what risk you're comfortable with. Some people are comfortable with no risk and absolutely fine. They just got to kind of make sure that their paradigm fits in that. Are they going to be able to generate enough money outside any investment performance to achieve their goals? So I'll stop sharing that for the time being. And then, as I said, any questions, I'd be welcome to answer anything. There's been a few from Fungo in terms of cryptos and stuff like that. And that always comes up. So I'm happy to stay around and answer some questions.
Thank you so much, Alan. That was awesome and a great overview of investments. I'm sure those who have picked what they've picked from these morning sessions have done so. Someone says, do you know about investing in South Africa, Alan? Alan is originally from South Africa, aren't you? So
I am, yeah. I'm not technically, I can't give advice on investing in South Africa, but South Africa's got a very, very well-established financial sector in terms of the funds. You got the mutual funds, the provident funds, and retirement annuities, I think they call them out there. So similar to the UK in terms of the tax relief available. The big play in investing in any kind of emerging market is always going to be the return versus the risk reward. You're taking a sizable amount of risk investing in South Africa. I mean, South Africa's economy, just to put into perspective, is quite a bit less than 1% of the global economy. South Africa's been knocked off the top peg in terms of the largest economy in Africa. I think it's Nigeria now and then Egypt. So you've got that risk. You've got the currency is a huge risk. We always get that. You can get 20% return on your Turkish liras. It sounds brilliant, but when they start adding zeros onto your banknotes, like some people obviously from Zimbabwe, you've lived through that kind of Reimark, Deutsche Mark kind of early 1900 in super inflation. That's an underlying risk. Fungai mentioned fixed income. If you're lending money to a company, like she mentioned Coca-Cola, or is it likely that they're going to pay their money back? Yeah, absolutely. If you invest your money to the Argentinian government, who's got a nasty habit of defaulting every few years, are you going to get your money back? Unlikely. And it's whether you've got that appetite for that risk. And obviously with the risk comes the potential rewards. But yeah, South Africa, as I say, we class it as an emerging market. It's quite a unique emerging market in terms of the stock market. So there's a company in South Africa called, well, it's a Chinese company that Naspers is a South African company bought in 19, I think it was 2001. I think they bought it, this tiny little Chinese startup. And I think it makes up about 60% of the JSE, the Joburg stock market now, just this one company. So, if you're buying a tracker fund in Joburg, it's, heavily skewed towards one Chinese technology company. Yes, it's a massive company, but it's again, is that risk that you're prepared to take? And if you are, great.
Wonderful. I am conscious I've kept you all sitting or walking or doing squats in front of your laptops for a long time. Thank you all for taking part. I've just put a case study in there of a guy called Bill Wang who lost 20 billion in 2 days. Go and have a read of it. A believer, Bible believer, church goer. So it just again looks at these things of, have you got the appetite for risk? I'm sure he had other assets. He might have lost 20 billion there, but he probably had other things. But putting things into perspective. So thank you so much, Alan, for just bringing the balance in as well, the advantages of pensions. I hear many a times people being told, just get rid of your pension, take it all out, do this. And so perhaps someone with a low appetite for risk is being told to remove money out of a relatively safe place and place it in a place where, if that thing starts moving up and down, it's like being put on a roller coaster ride that you just don't like. So, it's really important to just balance things out, upgrade your mindset, upgrade your education, really look at yourself. What are you comfortable with? What is your goals? Is everything that you're doing in alignment with that? So thank you so much, Al, for that. So yeah, I found that quite an interesting little case study. One that many people in today's age won't want you to hear. It's always like, you're gonna miss out, you're gonna miss out on the next big thing. But you know what? Everyone has a time. If you were going to make it big on something, just stick with what you're doing and learn the things that you feel an inclination to go towards. And that, it's a lucky break, isn't it, with a lot of these things. And you get that when you're more consistent and constant in what you're doing. So thank you